We are crypto derivatives, regulation, and a few other things. So we've got about 40 minutes to cover an impossibly broad topic, but this is a conference for crypto and trading, so let's do it. If everyone could just very briefly describe who you're with and what your company does. One sentence. Zach, you want to start?
Yes, I'm Zach Dexter, CEO of FTX US Derivatives, which is our CFTC licensed derivatives platform.
Okay. Hi, everyone. I'm Miao, and I'm the co-founder of MCDEX, which is a decentralized perpetual swap protocol that is powered by a high capital efficient AMM.
Hi, I'm Darius. I'm the founder of QCP Capital. We're a trading firm based in Singapore, a full suite cryptocurrency trading firm. We do spot derivatives, options. We do investing, and we build protocols as well.
Hi, I'm Antonio Juliano. I'm the founder and CEO of dYdX. We're the largest decentralized exchange by trading volume and focused on derivatives.
Dan Gunsberg, founder of Hxro Network, director at Hxro Foundation, DeFi derivatives, primitive built on Solana.
Awesome. I'm Ryne Miller. I'm the general counsel of FTX US. So these are real people, business people. I'm a lawyer, so I get asked the questions. So thanks to Salt and FTX for putting on the conference. Been really good so far, and thanks for folks joining our panel. I know you're here for Clinton and Tony Blair next, but we're going to give you a show before we get there. So we've got the exchanges, but Darius, you're here as the trader. You run a trading firm. You've got experience in options. You're trading a lot of crypto options. What are you looking for, product-wise, market structure-wise, from the crypto derivatives industry?
Well, I think the crypto derivatives industry, or derivatives as a whole, is an extremely significant part of crypto. I would say, as an instrument to crypto as an asset class, it's even more important than derivatives are in traditional finance. Starting off with innovation in perpetual swaps back then in BitMEX, it's created a lot of liquidity. It's become a main liquidity channel, and now that has been moving into DeFi. And DeFi is something that we see as something very important in the years to come, as more assets move there, as traditional banking moves into DeFi. So I think what we look out for is for the trading experience to be as seamless as possible, margin management, leverage, and I think the challenge, of course, for derivatives in crypto is, and especially in DeFi, is how do you manage the same kind of leverage and risk without an intermediary. And that requires a lot of innovation, and a lot of the guys on this panel are currently doing that. So happy to hear what their thoughts are as well.
Yeah, great. Thanks for that response. So I want to go to Antonio from dYdX, Decentralized Derivatives Exchange. Said the largest liquidity or volume or both, you'll tell us. But looking forward, and I know Zach is here, and Zach and I work together. We work at a centralized exchange. When are you going to make us irrelevant? Will you make us irrelevant? How? What catalysts are going to cause that to happen or not happen? I'm curious how you think about those things.
100%. No, I'm just kidding. Yeah. But I think longer term...
I disagree.
Yeah, I think it kind of depends on the timeline that you care about, in my mind at least. Obviously, we wouldn't be building dYdX in a decentralized way if we weren't really excited about the scope of what we can build. I always say our goal at dYdX is not just to become the biggest decentralized exchange, arguably we've already done that, it's to become one of the biggest crypto exchanges, period. And if you kind of look at the market right now, it's roughly like 1% to 5% of the trading volume happens on decentralized exchanges. But I think that'll change a lot. But I think it'll also take longer than people think, and that's okay. Our goal is to become one of the bigger exchanges on a 3 to 5 year time horizon, and I think that's pretty achievable. It's certainly not a given, and there's a lot of hurdles to overcome to get there. I think some of the biggest challenges just lie in the technical nature of what we're building. It's very complicated, kind of as Darius was alluding to, building margining systems, dealing with high amounts of leverage, dealing with the throughput that institutional traders and prosumers demand. But one of the things that really excites me about blockchain and in DeFi specifically is that the technology is changing really quickly, and it's changing exponentially. It's like getting exponentially faster every year, exponentially more scalable, and I think there will become an inflection point where it'll be technologically possible for decentralized exchanges to build products that are every bit as competitive from a product perspective as centralized exchanges. And then I think once that happens, there will be just a big turning point where a lot of people will start trading on DeFi, and it'll rapidly take on more market share. There's a lot of advantages to DeFi in terms of transparency, in terms of self-custody, safety, and I think it's just something that fundamentally wasn't possible in finance before, because for the first time in financial history, we can build these programs that execute totally autonomously, and people can just trust the code rather than trust us. And that's something that fundamentally isn't possible in totally on centralized exchanges.
That's helpful. I want to come back to a few points on whether it's user experience or trade conduct surveillance. Like where are some of the missing pieces and how do we solve those? But I want to start first with Zach. And Zach, I know you spend a lot of time on regulation. We'll do a shout out for our application at the CFTC now. But what about regulation is taking most of your time, and why is it important to get it right?
So for us, it's the detailed mathematical answers to why the margin model that we want to run in the US for derivatives is safe and effective. The regulator here in the US, the Commodity Futures Trading Commission, does an extremely deep dive into what's called the value at risk model, or the initial margin model that determines what percentage of the position notional you have to post in order to enter into the position and stay in the position on an ongoing basis in the form of maintenance margin. So that's all quantitatively driven here in the US. There are requirements to have certain quantitatively determined margin add-ons that are extremely sophisticated, and there's a whole set of methodologies that have evolved over the last 30 or 40 years or so for how you're supposed to calculate that stuff, how you're supposed to back test it, who gets to sign off, how long the review process takes. Working through that is definitely the most intensive part of launching a US derivatives exchange.
A reaction there is you're spending all this time proving to the US regulators how good the margin model is, how it's going to work in times of stress. There's about 200 billion notional, give or take, of crypto derivatives that are trading every day. The number's higher or lower depending how you count it. Most of that's not trading in the US. Most of it already trades on this model that Zach is spending a lot of time describing to US regulators. How do we know that what's already out there, if it's not gone through this CFTC deep dive, understood it's not being used by US traders, how do we know that it works, that it's good, that it's robust? Maybe to anyone that's working in this space.
Yeah, so the safety of a margin model is principally determined by how much margin you have to post. If it's 100%, then there's definitely no way you have any risk in the trade. If it's 0%, then the entire value of the trade is at risk. So the higher that number, the more safe the model is. And one of the interesting things is that in the US, you generally have to have much higher initial margin, but internationally, to Ryne's point, some of the margins initial margin on crypto derivatives products are like 3 to 5%. And there's an incredible track record on FTX.com and even some other venues of success in handling extreme volatility, even with those low levels of initial margin. For example, the largest one-day draw on FTX.com's insurance fund is something on the order of under $2 million. I think that's really, really an interesting fact. Given that you essentially have a fixed initial margin number of something like 5%. Here in the US, it's much higher than that, yet we've posted a $250 million insurance fund. So we've really gone above and beyond the call of duty to over-collateralize all of the risk in the system, but the experience internationally with much lower initial margin numbers where it's still safe and extremely so has been really, really interesting.
So I want to switch to Dan and a question that wasn't in the prep, so sorry in advance. But when I think about margin models and the risk that a user is taking when engaging in a decentralized platform, where's the feedback loop to say that we think this works? We, the users, think this is the right level of margin. We think we can think the risk could go higher or lower. How is that decided and then tested and reevaluated?
Yeah, so there's a couple ways that can happen. First of all, because of the transparency of DeFi, you get almost a public display in real time, and so you, as somebody who's participating in that network or interacting with those smart contracts, it gets a little easier to see because of the transparency aspect and because of all of these transactions going through the blockchain. It is right there for you to see. It's there for your community to see. Oftentimes, when you have a network that's driven through community governance, then there can be a collective decision or discussion to decide whether or not the margin model that exists actually works. But I do think, all of that said, I think that complete, independent, autonomous concept is great, and eventually we will get there. But there is kind of an intersection where there is a way, and let's take the US for example, because most DeFi derivative primitives do not interact with US persons, and they hopefully take steps to make sure that doesn't happen, and you introduce what we would call permission DeFi. So I think there's going to be a point actually where you have this kind of DCO concept, for example. So if you take like a primitive that's focusing on kind of the risk settlement.
And you said DCO, so some box that's in charge of looking at the risk and managing it.
Yeah, and I do see a future where you have this kind of node that could exist within the context of a decentralized network and almost act as like the eyes and ears of a regulator such as the CFTC. And as transactions are happening in this open software, so to speak, and that could be transactions that are happening from order books, from almost an infinite number of order books that are all tapping or kind of capturing or ingressing or egressing liquidity from this primitive. Any trade that goes between like a DCM to DCM or a DCM is involved in it, which means that arguably a US person is probably on the end of one of those transactions, that could then move to a DCO whose job it is then to clear and bring the transaction within the regulation that is current with the CFTC.
Interesting. So go to Gene. When you look at the user base now of DeFi, and that's a very complicated phrase itself, the user base of DeFi, is there a group that's not there? I think of banks, asset managers, institutional investors. Is it true that they're not there, and is there an opportunity to bring them in? How? What has to be done?
Okay, cool. I think generally speaking right now for the DeFi market, especially the derivatives like perpetual swap and options, mostly retails for most. And for those like institutions that I think we do have some conversations with them, like before we're trying to onboard some institution LPs. I think there are several key considerations from them. That one, for most, is definitely which is the topic of the day, is the regulation. Because I think they need to feel like pretty much confident before they make the real move. So that is something like when those conversations happen, that is a key consideration for them. And I think regarding that, like I said, there are different geos right now, like have different picture of regulatory environment for now, but long-term speaking, that we are all of us quite positive about that. But just like some like back and forth during this process. And I think the second thing that right now, one of their key considerations is the security of the asset, because generally speaking, I think they have a lower risk tolerant. And yeah, I think these are like some based on some previous conversations and past experience that those institutions are taking into consideration.
Yeah.
If I could just add to this
Please.
I think we've actually seen a really big influx of institutional players into DeFi in even just the past couple months. Currently on dYdX, we have most of the top market makers and some of the like buy-side funds trading on us.
Sure.
And I think people are excited about being early in something that could potentially be really big long term, and especially with a lot of the growth in volume that ourselves and Uniswap and others have had, I think there's a lot of opportunity for institutions to start playing in DeFi. And it's been really exciting to see that kind of migration start to happen in a big way in just the past couple months.
I can add one more
ahead.
thing to that also. Yeah, I agree with Antonio. There definitely is a move. I would define like I'm seeing more professional trading firms, hedge funds, where if I'm thinking of an institution, maybe that's like a endowment or a pension or an insurance company or something like that. But definitely that's happening. And I think one of the important things in terms of DeFi is you need to make sure that you are at a place where settlement is almost guaranteed because it is always going to get measured apples to apples. Like if you're looking at what is like what CME clearing does versus maybe what FTX, as a clearer is going to do, you need to make sure that you have a strategy ultimately that a large institution or a large firm that is putting a, has a reasonably large trade on, that trade is actually going to clear, whatever your definition of clearing is. And I think that once you have this kind of reflexive element of liquidity moving and insurance funds and kind of the risk waterfall becomes more and more hardened, then you'll really kind of see this exponential growth of some of those real institutions start to participate.
I think I've experienced there's two buckets of questions for banks, institutional traders, large asset managers. One is just understanding the risk waterfall, what it is, how much resources are there, and where exactly does it stop. That's sort of one set of considerations. The other is how much is actually there, like what is my total risk exposure. Zach, I wonder if I could go to you. When you're talking to a bank, for example, on possibly interacting with FTX US derivatives, what is it they're wanting to understand about the risk model before they start to go to that next level of considering signing up?
They'll certainly want to understand when they're going to be liquidated, if at all. Are they going to be liquidated in full or partially in a rate-limited manner like we do? What is their total liability at different points in the waterfall? When you start on a derivatives exchange, if you have a certain amount of outstanding risk and the market turns against you, usually you have to mutualize that risk in some way. Who's liable for what after what sequence of events is called the waterfall. So you typically start liquidating positions on the market if accounts are underwater, and then you'll move on to some other program and ultimately terminate at the clearinghouses or clearing brokers insurance fund or guarantee fund, as it's called here in the US. So just working through the examples of how the default waterfall would play out in different risk-off scenarios or times of extreme stress is not only part of the regulatory requirement, but actually part of the bank internal diligence and the broker internal diligence for connecting up to any new clearinghouse, really regulated or not.
And I want to get Darius' perspective. I mean, basically the same question. What do you need to see, DeFi, CeFi, whatever, before you start to put capital on that platform and trade it at risk?
I mean, just to touch back on the interest in DeFi. In Singapore, we've seen the regulator getting interested, some banks getting interested as well. But the biggest issue for them, and I mean, for private banks, they look at the yields in DeFi and the possibility there. I think they all salivate, right? The kinds of products they can build on there is amazing. So, but I think that for the regulator and the banks, one big concern besides risk is, of course, identity. They need to know KYC, AML, and I think the path there is perhaps creating permission pools. I think we've started to see some of that happening, but it hasn't really scaled up yet. Hopefully we see some of that. But risk-wise for us, I think, very much similar to what Zach has said. And for us specifically, because we trade in mostly non-linear products, we have seen how liquidations are done on exchanges like FTX and derivate. And specifically on derivate, if you see how non-linear liquidations are done, it's not as simple as for linear products, right? It's not a simple margin call stop out. It gets a lot more complicated. So the question for us is always how does that translate if it's on DeFi? Because it gets exponentially more tricky. So for right now, we are only comfortable so far for non-linear products trading on DeFi when it's fully collateralized. I know we've been speaking to Antonio a lot about this as well. Yeah.
Non-linear like options, right?
Exactly. So options, anything that is not perps or forwards, right? I think that innovation is very interesting to us. We want to see how that scales up because the truth is that DeFi has made derivatives more accessible than in TradFi, right? You can trade options with $1, right? And you don't get that in TradFi, right? And that's something very, very new. And you're opening this whole market of structured products and derivatives open to every user of any size, anywhere in the world. And the real question is, how the innovations that requires to manage this nonlinear option risk on DeFi.
I'll take it first. To me, DeFi is about the disintermediation of risk. And I think what you've seen even post 2008, pre-2008, if you think about what Dodd-Frank had to deal with, it was like the fallout of $700 trillion of OTC derivatives transactions. And what DeFi does, at least in my opinion, and I've been in the space in trading at least for 30 years now, is that it is a way to create real transparency and also have a way to disintermediate risk. If you take kind of what happened post-2008, you ended up with actually more risk invested or vested into a much smaller number of systemically important financial institutions, systemically important financial utilities like clearing facilities and things like that. And we're at this very transformative moment now where we have a chance to rethink how this all works, right? And I think what FTX is doing is, and I'll say it here, it's like we always say internally that they're kind of doing God's work right now because they're definitely leading the way for a new way to rethink, to think about how derivatives exist in at least in the U.S. context. And
We're here for you. We're here
thank
for
you.
you.
I appreciate that. And globally, how we're thinking about this from kind of the clearing risk and settlement space is really from this DeFi approach, and it is another alternative solution. And it is, this is kind of a meme, but it is early. And so, what we're doing, what dYdX is doing is really kind of testing the waters now. And we have time. Like, this is a long approach. Like, we look at this, like, we're looking at what does the next 10 years look like? And can we set this on a trajectory that then this does become a viable option at this primitive layer where you can develop through insurance funds and through different types of risk models and engines and develop the right waterfalls where things do clear and you actually, that risk gets disintermediated, gets spread out horizontally across a network of participants as opposed to being vested into kind of one single central point of failure.
Yeah, I want to gather up a few points and then, Gene, get your reaction to it. I mean, a few years ago now, we've all gotten comfortable with trustless transactions. Immediately settled, I send Bitcoin to you, no one's in the middle, there's no intermediaries, we're good with that. We solved for it. But to go to the next step, it's how do we get trustless risk and trustless credit exposure, and how do we manage that? And you've talked a bit about disintermediation. At the same time, we talked about permission pools, maybe KYC whitelist, other types of re-centralizing the decentralization. Is there a tension there? Gene can answer, but the rest too. Or is there a balance to be struck?
Yeah, that's a good question. I think, for example, one of the key meaning of the decentralization is that there is no intermediate party. That I think that which will bring efficiency to the DeFi, which compared to the centralized exchanges and centralized finance. I think this kind of feature is still in the process of growing. Like, for example, AMM is definitely, as we all know, one of the key innovations in the DeFi space that cut off the middleman. However, we do also know that there are still some kind of things that need to grow in the future. For example, the capital efficiency of AMM. That sometimes there are many assets lying in the AMM, but few of them are being used to provide the liquidity. Actually, it's something that we need to consider when we are designing the DeFi protocol. So yeah, I think for users, this is kind of a new way of trading, because before the DeFi, there's the way that they are trading or the way they are doing those transactions is actually sometimes is not like familiar with them. For example, I think that like Darius mentions that I think that institutions are looking for something that quite familiar with when they're looking for the DeFi space. So yeah, so this is something that new that the traders need to and the users need to get familiar with. And for us, the DeFi protocol builders, I think this is something that we are trying to build a similar user experiences so that we could easily to onboard the users, including the institutions and the retails.
We've talked a lot about access, market structure, products. The big part of my world with derivatives is more on the regulatory side and trade conduct. So I think about market surveillance, manipulation, wash trading, spoofing. That's all we do with CFTC for the last decade or so is enforcement actions on those things. Maybe start with Antonio. How important is that to your users, market surveillance? How do you do it? And then maybe Zach can follow on for his thoughts on market surveillance as well, running a registered exchange.
Yeah, I think it's obviously very important whether you're registered or not. Like, nobody wants to trade on an exchange where there is just tons of toxic flow going on or there's tons of wash trading. It's not like a good look for anyone. So we do take it seriously at dYdX. I think one of the ways that DeFi helps with this, as we kind of touched on already, is that it's very transparent what's going on. Like, anybody can just look at the trades that are happening. And we also work with third-party kind of compliance providers that statistically analyze a lot of the trading behavior that's going on, statistically analyze like who exactly is trading on the exchange, trying to make sure kind of from a statistical perspective that there aren't like sanctioned people trading on the exchange, that there's no wash trading going on. So I think it's very important. And I think it's something that has improved a lot in the entire crypto space over the past year, and something that we take seriously and are always trying to continue to improve.
So Zach, maybe your thoughts.
Yeah, in the centralized space, centralized exchange space, it may seem a little bit easier to kind of constrain the problem space. You're not thinking about minor extractable value, but maybe you are thinking about simpler problems like what is the redundancy setup of my centralized servers that are running the central limit order book on a few cores on one machine somewhere in US East 1 or whatever. So I think there are largely similar market manipulation prevention concerns, whether the exchange is centralized or decentralized. And as the blockchain-based exchanges mature and as the underlying protocols mature, I think we'll see a convergence there. Probably, frankly, where the decentralized venues end up using a lot of the same tools as the centralized venues to detect the same kind of behavior on a different substrate.
Interesting. So with derivatives, one of the big questions is liquidity. Where is it? Where does it come from? A slice of derivatives liquidity that I'm not sure it exists much today is this group of retail traders that have really gone headfirst into equities trading, for example. A lot of apps are now facing retail, there's fee-free trading, and they're trading stocks, and they love it, particularly over the last 2 years. Got very popular. Is there a catalyst or innovation that sees that demand start trading derivatives? Maybe for anyone. Any reactions? Or I can call on someone like law school. Dan.
Thank you, of course. Yeah, I mean, there certainly is, and I think it's something that's growing because things like derivatives, especially nonlinear derivatives, when you get into like options and things like that, it's definitely takes a lot more education. But like the way that we think about it is, we're building more what I would consider just, I guess, in the centralized world, more like back-end plumbing. Mm-hmm. And if you think about like it's more of like a B to B to C model where we're really building more for application layers to drive retail, and a lot of those applications, whether they're centralized applications or they're decentralized applications, actually already have a good amount of retail users. And I think something that by doing it this way is a little less challenging for us is that we don't have to necessarily get UI UX for a particular user set correct. And so I'm not competing at that level. What I am trying to do is provide the services underneath in terms of risk, margin settlement, clearing, and then making a very low barrier to entry to connect into the network and then kind of reap some of the benefits that exist with, in terms of DeFi and whatnot, and then drive the more of like the professional traders, market makers, liquidity providers in more on a DMA or direct market access. And so I think that just kind of building that combination and really relying on application layer partners to drive it and already have existing user cohorts, then it's really for them about educating and then growing from there.
Right.
Yeah, I mean, I would say that that is exactly what's already happening in crypto to this day, right? Like I always say that the crypto markets are somewhat different in their makeup than the traditional financial markets. They're much more driven by retail than the traditional financial markets. Not exclusively, of course. Of course, there's a lot of great institutions trading as well. But if you're an exchange or you're a trading platform, you really need to focus on getting a lot of that retail or prosumer flow. Just look at Binance, right? I mean, they do, $50, $100 billion a day in volume, and a lot of that is coming from retail. And I think it's a lot of the same energy that has gone into making Robinhood in the US and the equities markets really popular. I think trading actually is the killer use case, or at least the first killer use case of crypto overall. And it took us all like a while to figure that out, but crypto is really the perfect thing to trade. It's really easy to build an exchange. You can send it all over the world. It's very international. There's like interesting market structure and volatility. But I think just focusing on making a great retail trading product is super important for an exchange, and is something that will also continue to improve over time.
Crypto is great for trading because it only goes up. And so it's like the perfect asset to trade. We got a couple minutes left. We'll do our down the line closer. The question is, at this panel next year, crypto derivatives and regulation, what will be the topic, the big topic that we're talking about? I'll start with Zach.
Well, obviously the massive success of our new margin model in the US. Leave it at that.
Perfect.
Well, I think that will be like the more innovations to realize derivatives product like perpetual and options in the decentralized space. Yeah.
I think something that Antonio hinted at, right, that the importance of crypto derivatives as the only scalable financial ecosystem that is non-sovereign and independent. So it's not just next year, but down the road, I think given the geopolitical situation we have, it becomes a very, very important piece of the financial puzzle because we see assets move there for that reason. And so building a proper derivative infrastructure is extremely important because that's how we are going to manage our finances going forward. So something to think about.
Yeah, I think two things. First of all, I agree with Zach, certainly, in terms of it'll be really interesting to see what happens with the more regulated derivatives plays, especially in the US, and if they can capture a lot of volume. And it definitely seems likely that that will be the case on some time horizon, so that'll be interesting to discuss in a year. And then also just the continued proliferation of DeFi, like I talked about right now. We're only 1 to 3% of the market. I like to think that'll continue to grow a lot over time and will just continue to become an even bigger narrative.
Yeah, similar to Antonio, definitely the continued evolution and importance of DeFi in the derivatives construct, and also probably a lot more around permission DeFi and the tools at the kind of the application layer and below that help drive things like how to become more regulatory compliant within the context of a DeFi network.
All good answers. I think there's this inevitable trend towards valuable material liquidity. Darius previewed this, being on these platforms. And if you're asset manager, you can't meet your mandate if you're ignoring this important source of liquidity. You're just not trading in an effective way. So join me thanking our panelists, and thanks for coming to our show.